Hi, welcome to the It's Your Money and It's Your Estate Spring 2025 workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Now, let's start the program. This webinar is the fourth session of the It's Your Money workshop series. The topic of the day is investment world. Our moderator is Peter Kote. Our guest speakers are Paul Horn and Michael Allbee. And this webinar is brought to you by Segastrom Center for the Arts. Enjoy the workshop.
Michael, come online. Da, 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 da.
Hey, Pete.
Yeah, we'll do a little song and dance.
You don't want to see me dance.
Okay. Then, if I'm not going to see you dance, let's talk a little bit about why you're here. You're here to make the presentation for the investment world. But before we go there, let's review your Ask First form.
Yeah, we're gonna share with the under the big top circus how Wall Street and people get paid and making sure everyone's educated.
Yeah.
Let me share. All right, you should be seeing my Ask First.
Yeah, here we go. You got a bachelor's degree. Where'd you get it from? And what was your topic? Was it related to what you do?
Yes and no. Go Bruins, UCLA, my undergrad. But my degree was in psychology,
Well,
and I'd never thought I would be in finance. But that was my kind of first job out of college was accounting, and then got into the space I'm in today as a financial advisor. But then I started to realize, wow, I use psychology a lot to keep people calm and invested and dealing with emotions because finances are a
yeah.
very personal business.
Yeah, the mind is not very trustworthy when it comes to money.
No, and there's a whole new field of behavioral psychology on the finance side. So
Yeah,
it's very interesting.
yeah. In fact, there's probably a Pulitzer Prize winner in economics, and he was a psychologist.
Yep.
Yeah.
Yep.
Yeah, it's a fascinating field about how the mind works as far as money is concerned. Talk a little bit about your firm. You got 18 years of experience in the fee-only fiduciary world.
Yeah. So I've been with Benefit Financial Services Group, one firm my entire life, and so it's been a great experience and ride. So the only thing I know is fee only. I've heard stories. I've got colleagues who worked on the broker side, and so I'm well versed on seeing what's kind of over there as well. But I feel like being a fee only advisor, always putting our clients first, and having that responsibility as a fiduciary is very important. And like you said, I've got my CFP, so not only as a registered investment advisor, uh, having that fiduciary responsibility, the CFP, Certified Financial Planning Designation code, also requires that you act as a fiduciary.
Yeah. There's lots of different types of firms. Do you describe your firm as a financial planning firm, or do you describe your firm as more of an investment firm?
We're wealth management. We're very comprehensive. We do full investments for clients, but we also do build financial plans and dive deep into various topics that affect our clients because we feel like you build the roadmap and then build the portfolio, and they go hand in hand together.
Why
So
don't you
we think
scroll
that's really
down a
important.
little bit so that we'll see the rest of your Ask First form?
Yep.
You're licensed, and you can find you on FINRA. Series
Yep.
65 just basically means that you can give investment advice, but it doesn't mean that you can sell anything. Are you commissioned to sell any kind of financial product?
No, in anything we do that if we determine a need for a client who needs insurance or some other product, we refer that out. No referral fees, no commissions, no nothing like that. It's the
Okay,
only way we get paid is from our clients.
okay. Talk a little bit how a client pays you.
Yeah, so it's based on typically assets under management. So if client gives us money to invest, we charge a percentage based on that.
What is that percentage?
On average, it's about 1%. That's the starting, and then it scales down from there. So typically anywhere from a 0.5% to 1%, depending on the assets under management.
And you do hourly?
We do hourly. That's typically if a client only wants to engage us to build a financial plan. We do an
And what
hourly plan to build that.
and what's the rate on
Yeah,
that?
that
What's your
rate
hourly?
typically is between $250 to $400 on an hourly rate. To build a financial plan, depending on the complexity, it's typically starts around 2,000 to 2,500.
Okay. And do you give any kind of a free look if somebody is interested? Do you meet with them at no charge?
Absolutely. We want to at least try to help, and that's kind of been our philosophy is help whoever we can, or at least point them in the right direction. And so, yeah, not,
What should they bring to you on that free look or the free time that they have with you?
yeah, we're typically wanting to see the investment statements, if they have a balance sheet of assets and liabilities, and then typically a tax return as well.
Okay. Did you classify your firm as an active manager or a passive? And we'll get into the meaning of that a little later on.
Yeah, I would say I mean, an active manager in the sense that we are actively and proactively managing a portfolio and rebalancing and tax loss harvesting, which we'll get into. But we use both active and passive strategies in our firm. We kind of take a hybrid approach to keep fees very low and for tax efficiency.
And you're not associated with anyone who sells mutual funds, insurance, annuities, etc.
Correct.
And who's your custodian?
We use Schwab and Fidelity as our two custodians, the two largest ones out there. And it's
Okay.
really important to have a custodian so you don't be the next victim of a Bernie Madoff scheme.
Yeah. So today's topic in investment world, let's go to your outline, and I'm going to just talk a little bit about today's topic, the overview. We put the investment world topic together today. Well, first of all, Michael can do the entire series, 6 weeks. Okay. We've asked him to focus in on what is the typical individual out there going to meet when they go in and try to invest in today's world. And the fee only model that we only bring on fee only fiduciary advisors that are have do not sell any product on the program here. However, that's not the norm. And so we're going to go through what 90% of individuals see in the investment world. So, and we'll try to contrast that a little bit as to what Michael does in his firm. And so let's get into the program, Mike. Let's go to the next slide.
Yeah. I'm going to skip through the bio since we covered those.
Yeah, the regulation in this area is so confusing, but you hit it on the nail on the head when you talk about registered investment advisor versus a broker. And this is the language we're going to use. What is a registered investment advisor?
Yeah, and they make the language so confusing, and that's on purpose. Because you again, how do you get paid and who's a fiduciary or not? So a registered investment advisor is someone who's registered with the Securities and Exchange Commission. They're the regulatory body that watches over advisors. And as a registered investment advisor, you have a fiduciary standard, which again is always putting clients' interests first and doing
But
what's right
people,
for
I don't
clients.
think people really understand what that means. Oh, doesn't everybody put their clients first? And the thing of it is,
You,
the answer is no.
No, you would hope so, but unfortunately, no. And again, that obligation. If someone calls us up and says, "Hey, Mike, I'm considering paying off my mortgage. Does that make sense?" We will run the numbers, show them the numbers, and then guide them. Hey, yeah, it makes sense. Pull out 300,000 from your portfolio, pay off the mortgage. That's not in our best interest because we're managing the money getting paid on 300,000, but it's in the client's best interest. So, but that doesn't happen. That guidance, it's lines my pockets, unfortunately, too often of the time.
Yeah. What is a registered representative?
Yeah, so a broker, think Merrill Lynch, Morgan Stanley, Smith Barney, Goldman Sachs, and the likes, J.P. Morgan. So this is where the water's been muddied a little bit over the years. They used to have more of a suitability standard, only doing what's suitable for you. Now they have a best interest standard, but it's more still of a transactional relationship. They
It's
only have to give best interest at the time of the recommendation, and they don't need to know your whole picture. And so, what's in your best interest at the time, they may be selling you an insurance product, but they're not going out and shopping for that and understanding, do you really need an insurance product
they've
based
they've
on your
they've they've
situation?
they've they've they they've taken the best interest, those two words, and defined it to their needs.
You got it. The industry is very powerful.
Yeah, it is amazing how they've taken an English word and completely twisted it.
Yeah.
So
The other, yeah, and the other thing I want to make sure everyone knows is fee only on this page. And we talked about that again. The only way we get paid is based on a fee that you're paying us on assets that we're managing. But there is another word out there called fee based. And that may be where they charge an asset under management fee like we do, but they also may sell you insurance products for commissions and annuities and so on. So fee-based and fee-only are two very important things to come away with from this. And
let's
ask
go
your
to the next
advisor.
slide.
Yeah. So not all advisors are equal.
Is
And
there a rule as to what you can call yourself, by the way?
Yeah, I mean we are a financial advisor, a wealth management
But there's
advisor,
no
but
rule you can
but
call
there's no
yourself.
rule. Anyone
Yeah,
can call themselves a financial advisor.
yeah.
Um, some things to look for, again, make sure they are fiduciaries. We talked about fee only versus fee based. Some of the credentials, the three listed here, there's thousands of different credentials. But the three here, the certified financial planner, the CPA or certified public accountant, and chartered financial analyst are the three kind of flagship and most widely recognized and difficult to get. And you see the specializations, it's either investment management, financial planning, or taxes. But no, only about 30% of financial advisors in the United States have a CFP. So it's designations to look for. But bottom line, the most important thing is, do you like the advisor that you're working with? Do they have a similar philosophy as you? Do they meet with similar clients? Do they offer the services that you need? And so those are really important questions on searching for a financial advisor.
Yeah, and please look everyone up. If you have a wealth manager or financial planner or whatever they call themselves, please scroll up just a little bit. I think,
Oops,
yeah, nope. There's another, um,
there's
uh,
a review form ADV.
yeah, what
There's a
is
link.
that?
Yeah, so every advisor that's registered with the Securities and Exchange Commission is required to file what's called a disclosure brochure, Form
Ah,
ADB.
there it
Um,
goes.
and that tells an investor what services they offer, any conflicts of interest, what the fees are, and so on. So it's a good way. It's a very boring document, but a good way to understand what your advisor is offering. But then there's another link there called Broker Check. I recommend everyone check out their advisor on that. It's kind of like you have to, if you're registered, you file there and it tells you your background, your history, and then most importantly, if there's any red flags, lawsuits, or anything
Disclosures.
else.
Yeah. I was reading a couple of years ago that Oppenheimer, 20% of their sales force have a disclosure,
Yeah. And that's
which is a
because they sell a lot of products with commissions.
yeah, I know, but I mean, um, here in Laguna Beach, we had a business person who was just indicted for stealing close to 5 million plus from clients, and he was on broker check,
Yeah.
and somebody could have seen, and it was available to anyone to say that he's had a bunch of consumer complaints and
Yep.
regulatory issues. And that's what a disclosure is. So look everybody up. Uh,
Absolutely.
Broker check is great. Ask first form. How long did it take you to complete the ask first form?
Um, a minute or so?
Yeah. Was there anything offensive on that form?
No, no, they're
No.
all great questions and
Yeah.
straightforward. It's very
Yeah.
easy.
So if you see a license, for example, somebody has a Series 6 or Series 7, which I think you're going to go into in the next slide,
Yeah, I'm going to skip that one. We'll jump right to that.
that means there are going to be sales. And here's what they mean.
Yeah, it's series. The big ones to look for is series 763. Those are ones that most likely they are at a broker, and they are selling you something. You have to have those two licenses to sell. I have my series 65, as Pete mentioned. That's just to give investment advice. These licenses really, I mean nothing. I studied for like a week and passed my Series 65.
Yeah.
Whereas the CFP designation, I took courses at UCI, 7 courses, and then had to pass a rigorous exam. And you have continuing education every year. Whereas the Series 65, it's passed at one time, never any continuing education. Very simple to get.
Yeah. When you get hired by an insurance company or by a Merrill Lynch or Morgan Stanley, the question is, can you sell? And that's the bottom line.
Yeah,
And
and they have training programs where if you're in kind of this probationary status where you can't bring on clients until you pass the 7 and 63, then you can start to bring on your own clients. And if you don't pass those exams, then you're out the door for those companies.
and then they put you on the phone. And
Yeah,
so,
then they put you on the phone and start dialing for dollars.
dialing for dollars. I mean, it's it's it it's the it's literally still works that way today. I mean,
It does.
it's not. We have this picture of that only like the some of the movies that come out about the boiler rooms in the back, and it's just a little bit more sophisticated with a Morgan Stanley and a Merrill Lynch and an Edward Jones.
Yeah,
Uh,
they have great business development and marketing programs and training and everything. And so it's yeah, but
it,
it's just more
it's not
sophisticated, but
about it's
the same
about
thing.
selling, not about learning about money. I mean, it's amazing. So if you're not selling, would you have these licenses?
No, you wouldn't have the Series 7 or 63 if you're not
Yeah.
selling.
You would just have the Series 65, which is more of a registration that you're giving investment advice.
You got it.
Let's go to the next again. Broker check.
Yeah,
Look people up. If you have never looked your advisor up, please do so.
yeah,
Anytime somebody tells me they're in the investment world, first thing I do is go to broker check.
yeah. So we're going to now get into the products that get sold. So we covered the industry and how it's structured. And
This
this
is one of the biggest.
yeah, life insurance is one of the biggest. And what's on the left-hand side of the screen versus the right, the left rarely ever gets sold by advisors because there's no money in it. But that's 90% of the time, probably what you need is term insurance versus permanent. So term, think of it, it's in the word. It's supposed to last you for a specific period of time, a term. Typically, that's 20 years. It's very inexpensive the younger you get it. Premiums can usually stay level. And then you have it until a certain age. Say it's age 60 or 65, right at retirement, and then it goes away. Some of them have conversion privileges where you can move it to a permanent policy if you have some type of health issue. But it's meant to serve a need during that period of time. For example, personally, I've got a mortgage. I've got two teenage boys and they're not in college yet. And so if I were to pass away, I would want that insurance to cover paying off the mortgage, supporting my family, and getting the boys off to college. Those things hopefully go away. Hopefully, I have my mortgage paid off by retirement. The kids are through college, and I don't have a need anymore. That's what term is for. Uh,
Permanent is, on the other hand,
Exactly. Completely, it covers your entire life, not just a term. It's much more expensive. Commissions are very high on them. That's why these get sold. And they unfortunately get sold as like an investment product. Yes, they have a cash value that grows over time. That cash value is meant to help pay for premiums in the future, but it gets sold as this is an investment product. And that's just not the case. We don't see that. And so permanent, think of whole life, universal life, so on. There's a time and a place for these policies, maybe for estate planning purposes, for paying estate transfer taxes and other features, but most of the time, the policies aren't needed.
if somebody has a permanent life insurance policy, should they go back to their life insurance agent and ask whether or not this is necessary?
Yeah, absolutely. And see if it's
Oh, don't go back to the
oh,
life
not to
insurance.
them. Don't go back to them. No, go to
No,
an advisor
go to an
uh,
advisor. Go
because
to
they're
a
going to tell you, yeah, absolutely is
yes,
necessary and show you all the illustrations and everything.
yes.
You should understand why are you in a product. And again, we're not trying to say these products are all bad and there may
Yeah.
be a use case, but we're just trying to point out what gets sold versus usually what's needed. And that's just because they get paid higher commissions on these.
And
Um,
and
and so
they're
there may be an
difficult.
opportunity to either, I mean, get rid of the policy if you don't need it,
Cash it in.
or what was that,
I
Pete?
said you could possibly cash it in and do a different type of investment.
Absolutely. See what the cash value is, cash it in, and do a different type of
Maybe
investment.
it makes a great charitable gift to a charitable institution,
Yep.
so
Yep.
permanent life.
Or reduce the coverage and pay a lot less in.
Yeah,
So there's lots of options, but you're right. Don't go back to the insurance agent because they're going to tell you yes, you need it,
yeah,
or sell you a new one.
yeah, yeah. And you don't get any kickbacks on from a life insurance agent, correct? On
No, we send it out to a life insurance broker so they can go shop for the best rate out there, not just going only to one organization. So yeah, there we identify that there's a need for insurance. Most of the time, it's term insurance.
what I
And
was
and
surprised at here in California, there is a law here in California that that an insurance agent cannot work on an hourly basis for someone to help them out in the insurance area. They
no,
can only work on commission.
they only work on commission.
I find
Um,
that that it's part of the law. That's how powerful the insurance industry is.
The
It's just
insurance industry is
amazing
very
here.
powerful, and it's regulated by the states. The
Yeah.
state of California, it's not the federal government. Each state has their own
There's no
regulation over the.
national, like FINRA and the SEC controls the financial world all over the United States. The
Yeah,
insurance industry is controlled state by state.
yep,
And that's why most of them are in Delaware and Iowa, etc., who have the least amount of restrictive laws for the insurance companies.
Yeah. Yeah.
Let's go to the next slide.
Yeah, so get into another type of insurance product is an annuity. Annuities, I mean, it builds savings and creates income, but there's a cost for that. And there's different types of annuities that are deferred, as listed here: fixed annuities, variable annuities, and index annuities. And we'll start off with fixed, which is the most simple. Think of it as just like a CD. It's very similar to a certificate of deposit. You pay a single premium. You're guaranteed an interest rate for a specific period of time, typically 3 to 10 years. The longer you defer it, the higher the payout. And then the annuities, though, the most important thing, again, they're backed by the insurance company, not FDIC. So you have to don't get teased by the high interest rate, because that probably means that that insurance company is not the best rated, and they're teasing you to get your money.
And usually the tease rate is temporary, although they
You
call it the fixed rate.
Yeah, they'll give
It,
you a bonus or something like that, and it's a
yeah,
teaser rate.
the
Um,
language is very, very confusing.
Yeah. And fixed annuities, again, could be good in certain cases if you're just nervous Nelly, put your cash under the mattress. But again, we prefer CDs or a ladder of treasury bills. It provides more liquidity. The problem with these fixed annuities, they're fixed for that period of time. So someone just a few years ago, when interest rates were lower, fixed at 3% for the next 10 years. Interest rates today, I can go buy a treasury bill and get 4+% on that. And so inflation protection is just not there on these fixed annuities.
And it's not liquid. So one of the things that we always recommend is that before you invest, ask, how do you get out of these investments? And so in an annuity, what is a surrender charge?
Yeah, so I'll jump forward and then jump back. So surrender charge is covering the commission. So if I'm a advisor that just sold you an annuity, and they got paid a commission, typically that commission's in this example we're showing 8%, which is normal. And so the insurance company, I sold the annuity to a client. The insurance company paid me my commission, but then say a year later you go, I don't want this annuity, I want to get out. They're going to charge you a penalty to get out. That penalty is coming back into the insurance company because they already paid out that insurance agent. So it's really to cover the commission. And so go
Go
ahead,
ahead.
Pete.
Yeah, well, the insurance company commission is also related to you with this is at no charge to you. The insurance company pays me.
Yep.
This is how they get the money. The insurance company gets their money back.
Yeah. And this example shows 7 years, but I've seen it go out to 15 years, which is crazy, where you are locked into this product, and if you sell out early, you pay some type. Usually it's scaling down, but they are very illiquid products. One tip though is most annuities allow you to withdraw 10% of the contract value per year without penalty.
Yeah. So that's a methodology of getting out of annuity. Let's go back to your previous slide.
Yeah.
The variable annuity, Forbes magazine called it at one time legally stealing. What is a variable annuity?
Yeah, and you don't see them. I mean, you still see them sold because they are high commission products, but
You don't see them as
people
much.
have, you don't see them as much because people have smartened up. But it's really, again, an annuity creates a stream of income, but you take all the risk, all the investment risk. You can make your own investments in stocks and bonds and mutual funds that they have in the platform.
But
And we'll
the
get into
most,
the fees in a little bit.
yeah, but the most sold one today is the indexed annuity.
Yeah, and they've surged in popularity, like you just mentioned, Pete. And these kind of have characteristics of both fixed and variable annuities, kind of a hybrid. They give you a rate of return based on typically an index like the S&P 500, the 500 largest U.S. companies, and they go, hey, you're going to have a floor You can never lose money, or maybe you can only lose 10%. But then they cap you also on the upside. So if the S&P 500 index is up 20%, you're only going to get 10% of that, and we
Yeah.
collect the other 10%.
And these, many of them carry a 15% commission on these. And even the Merrill Lynch's and the Morgan Stanley's do not sell the indexed annuities because their in-house believes that it's not even suitable for most of their clients. So a lot of these indexed annuities are being sold by the smaller brokerage firms and the insurance company. I don't even think you have to be licensed as a financial advisor to sell them.
You don't, and one of the things too, they unfortunately the way they get sold is, hey, especially to risk adverse investors, you can have no downside, all the upside for no fees, which we all know there's no free lunch. The way the fee is taken out is again on that cap where they're gonna cap you a certain percentage upside and they take all the rest. That's where their fees are built into.
And
But
these are sold at the free dinners, at restaurants and
yeah.
give you a
And
little
again,
bit of
that's where the
wine.
commissions are higher. The variable
Yeah.
annuities, the index annuities, you don't go to those free steak dinners and hear too much about fixed annuities.
No, you hear about indexed annuities mostly. Let's go to the next slide.
Yeah. So,
We talked about that. We
yep.
talked a little bit about, you know, it is very, not just in the variable annuity area, but it's very difficult to understand how these commission products are charged. So in the variable annuities, your example is just a real good one because it shows the fees that you pay is close to 3.5% per year.
Yeah, and it could be even higher because the the mortality and expense, that's the general cost to have the annuity, is typically around one and a quarter. The administration's typically 0.25%. That's just to send out statements and so on. The underlying fund expenses on average are about 1%. You can create it a little lower, but you can't go create a very cheap portfolio because the underlying mutual funds that you can invest in, there's a set menu, and most of them have higher fees.
The
Uh,
average, the average broker fees are 3% per year. Fee
yep.
only advisors, the average fee is 1% per year, and they get low cost products or least expensive to put your investments in. But people go, oh, 1% per year. This is expensive. And it isn't. You just can't see the fees that are being charged on these products, starting with annuities, mutual funds, limited partnerships, hedge funds. You,
And you
you know,
really have to read through the contract, and that contract's, 50 plus pages. And the key too is what they try to sell on top of that is these income riders, like this living benefit rider, designed to pay monthly income for life or some type of COLA or inflation adjustment. The annual rider fees typically range between 1 to 3%. And
yeah.
so they're already collecting, call it 2.5 to 3% on the other fees, and then they sell you a rider on top of it. And so in this example, again, 3.5, but we've seen commissions all the way up to 6% on these.
Yeah. And by the way, a living benefit rider is considered suitable. It's not considered that if you were a fee only advisor, you did a living benefit rider. I mean, that would not be in the client's best interest, and you could be subject to liability. But in the brokerage world, in the sales world, it's a suitable product for you.
Yep.
No
And again,
liability.
variable annuities, luckily, investors' education has been out there. Not too many of these seen. A lot of legacy ones, but not too many new ones are sold. Again, kind of getting into the big one out there with most popularity today is these index annuities, where they have caps on the upside that usually reset every kind of 1 to 6 years. And again, you can choose that buffer, how high your cap is going to be versus the index performance. And there's
Well,
so many
well,
different, it's like a rocket scientist to figure out how the index is being calculated. If it's 1 year, uh, point to point crediting method and so on.
yeah, yeah. What I love about this slide, look at the annual index rate.
Yeah. So this is obviously a worst case scenario, but a real life example. We had a client come to us with an index annuity, and we looked in 2020. Uh, this specific index annuity had a monthly cap of 1%. And so, as it highlights here, month one, January, the S&P 500 was up 3.2% that year. They got capped at 1% or that month, they got capped at 1%. The next month, February, the market was down. They took all that downside and so on. And then they average or aggregate all these, just add them all up. The sum of those cap monthly rates ended up being 16%, negative 16%. And they said, well, you can't lose money on this product, so we're giving you 0%. What the market ended up doing, it was up almost 16% that year.
Yeah, and you could have
And
done it for in an S&P 500 fund for less than 1/10 of 1%.
yeah, 0.03 or something like that
Yeah,
to
yeah,
buy an S&P 500 index.
uh-huh.
Again, they prey on the volatility and say, and you can never lose money, but the way they calculate these things, it's not very straightforward. And uh, again, I mean, there could be some index annuities that may make sense for certain individuals, but again, the ones
It's
that
the
get sold are ones that are not typically in your best interest because that's where the commissions are for these products.
Another thing on the opposite side is that what you should take away from this is that a good fee only financial advisor is a good number cruncher. That's, you need to be able to crunch the numbers to see whether or not a particular product is good for you. I
And
mean,
and and you
I,
need
I
to know the volatility of the market because how this index annuity will perform relative to the index greatly depends on market volatility.
Yeah. Well, I've seen some of your spreadsheets, Mike, with Pat and in the past where you analyze mutual funds, and the spreadsheet is just absolutely enormous of all the things that you go through in doing the analysis. And it takes time, it takes effort, and it's about number crunching. It's not about hey, buy this particular product because you can't lose money.
Yeah. Yeah, not at all. And you need to really dig into the numbers. And the other thing, just digging into the numbers, is these index annuities, they do track an index, but only the price of that index. They don't account for dividends. Historically, going all the way back to 1926, dividends have contributed about 32% of total returns for the S&P 500. And this chart is just showing an example of if you invested $10,000 back in 1970, that would have grown to $3 million approximately
Yeah.
with dividends reinvested. That's that orange line.
I want
If you
to
don't,
I want to just extend this a little bit because the S&P 500 is used a lot as indexing your portfolio. What does that mean?
yeah, so you take a market index, a broad market index, this is again the 500 largest US companies, and you're trying to track performance to a certain extent to that. That's not always the case because these indices have no fees, don't take into account tax considerations, and they may not be suited for the risk that you're wanting to take.
Yeah,
Uh,
but a lot of times the S&P 500 comparisons to a mutual fund do not include the dividends.
yeah, they do not, and they should again. And these index annuities, do not include dividends on the index that you're tracking. So you're missing out on the compounding of those dividends again, which drive almost a third of historical returns.
If you're into sales, there's a lot of way to mislead you. So one of them is to show you an S&P 500 chart without the dividends, so you wouldn't know the difference. All you would hear is this is the S&P 500 return, and they would be
Yep.
correct partially, yeah, but it's not the full story. Let's go to the next slide.
Yeah, so we've covered now annuities and insurance. Now we'll get into different types of investments, vehicles, mutual funds, exchange traded funds or ETFs, and stocks and bonds. And so I'll start to the right first in the yellow. A stock is just you're an owner of a company, a very tiny owner, fractional ownership. But if I buy Apple stock, I participate in the earnings generated from Apple stock and any dividends or return of capital to me. A bond is I lend my money and get it back in return at a set date for a set interest rate. So it's kind of like a mortgage, think like that. So you can buy individual stocks, individual bonds, but there's an easier way to do that than you selecting your own and doing the homework and the costs involved with that, especially on the bond side of things. You can buy mutual funds, which pool your money together with other investors, and then a manager selects those stocks or bonds for you and creates diversified exposure. Or an ETF, which is kind of a hybrid between a stock and a mutual fund. It's still pooling money together, but it trades more like a stock where you can trade it throughout the day instead of end of day and provides more transparency and typically more tax efficiencies and they are more cost effective as well.
And there are only 20,000 plus mutual funds out there. New ones form every day. Mutual funds close every single day. There's maybe now, there used to be maybe 3 or 4 ETFs. Now I think there's over 200.
So many. I mean, they're
Yeah,
they're launching probably, I mean,
there
five
are
to ten
more
ETFs daily. Like
Yeah, there are
it's
more mutual funds out there than there are stocks on the New York Stock Exchange.
yeah,
So,
absolutely.
why are all these investment vehicles out there?
uh, Fees.
Fees.
How do they get paid? Advisory investment firms from Vanguard to BlackRock and so on, they get paid fees, and then advisors get paid fees. There's two ways the funds, ETFs and mutual funds, and primarily we'll focus on mutual funds. There's two types of expenses. One is the ongoing annual expenses, and
Which
then
is
the other,
legitimate
which
for
are
paid,
legitimate. They
which,
go to
you got to
pay,
pay the investment manager
yeah, but you have to know again, what are you
is
paying? Because
what
this is
is
come out each
reasonable.
and every year. And this doesn't come out from like a fee that you see as a line item on your statement. It's coming out of the performance. Um, and so this is just showing mutual funds, the top panel, where fees typically are on average for both stock and bond mutual funds is around, call it 0.4%. Uh, and then exchange traded funds, the bottom panel is typically around 0.1 to 0.15. ETFs are typically much cheaper. Not all the time. ETFs can be more expensive than mutual funds. Um, and that just is driven by the fact that most exchange traded funds are passive investments, whereas most mutual funds are actively managed. And so just to give a brief, because I think Pete, you're going to cover this in another future
Yeah, we're going to cover
class.
that as how should you invest your money, and we're going to talk about asset allocation, etc.
Yeah,
But there's the vocabulary is important. So passive means what?
passive means you're just trying to track that index like the S&P 500. You're never going to do better than it. You're always going to do slightly worse because of the fees.
And then
And
active is
you're trying to beat that index. So the manager is actively trying to pick stocks that will beat that index over time in both up markets and down markets.
So besides fees, when you meet with a financial advisor, you need to ask them, what is your philosophy? They need to align with yours. And so ask them to explain their type of investment management. How do they go about picking the vehicles that will implement your plan?
Yeah. And the two things that we can control is keeping fees low and trying to drive taxes lower and be tax efficient. I can't control what the market's going to do on a day-to-day or annual basis. I'd love to. I probably
Really?
wouldn't.
You can't? Why are we talking to you?
I wish I could, but if
Yeah.
I if I
You're
if
not
I
going to
would,
hear that. You're not going to hear that statement on MSNBC,
no,
the
no. All the
business
talking
channel.
heads think they know what's going on every
Yeah.
single day and what's
Kramer, I
causing.
don't think will lead off with his program and saying, I'm sorry, don't know what will beat the market today.
Yeah. But what I do know is, and we point to history, is markets go up more than they go down and compound wealth and earnings grow over time, and that benefits long-term investors.
Yeah. Yeah.
But again, knowing your advisor's philosophy and process is very important.
So fund expenses is one of the huge issues when you're looking at an investment vehicle.
Yeah. The
Let's go.
other giant issue is the loads, the commissions.
Loads
That
is another word for commissions.
Load is another word for commissions. You avoid this by working with a fee-only advisor, but brokers often sell you mutual funds that have commissions, and you can tell that by looking at your statement. That's the homework assignment for everyone on the call: is pull out your brokerage statement and see if you have a mutual fund that has an a B, or a C after the name. If it does, then you paid a load, you paid a commission. An A is you paid an upfront commission, and that commission typically is kind of in the 5 to 6% range. A B is you're going to pay a commission on the way out when you sell that. You don't see too many B load funds anymore. And then C is you're paying a higher expense ongoing each year, typically around 2%.
I see
Which
the C being used by brokers who call themselves fee-based financial advisors.
Yep. Yeah, that's where
Explain
you
what
see
that
on the
means.
fee based, and then the brokers at like a Morgan Stanley typically you see an A share class.
Yeah. Because fee-based, if you look at Class C, no initial fee, but they're higher expenses on an ongoing basis.
And so I can buy the same American, like I'll give an example, American Funds Growth Fund of America. Uh, I can buy
How
an A
big is the
share.
Growth Fund of America, by the way?
Oh,
It's one of the
it's
largest.
one of the largest. That's why I gave the example. I don't know what
Yeah.
the assets
I
are
mean, it's
today.
billions.
It's billions. Yeah, it's billions. Um, but I can buy that fund, same manager, same underlying performance, but I can buy the A share class, a B share class, a C share class, an F1 share class, an F3 share class, and so on. There's all these different share classes that have lower ongoing annual expense ratios, and some of them, the A, B, and C, have commissions up front. And so you, again, make sure you're talking to your advisor, like, why wouldn't they be buying the lowest share class fund for you that they can?
And many, many mutual funds do this. PIMCO does the same thing. The fee-only advisory world can buy what's called institutional shares. And most of the time, the institutional shares are the lowest priced, no commission type investment vehicles.
Yeah, if you try to go open up a Schwab retail account and buy a mutual fund, you're buying what's called typically a retail share class. It's not going to have a load like we're talking about here, but it still has an expense ratio, and that's typically higher than these institutional share class or retirement share classes that we can buy for our clients because again, we're taking our scale and pooling money together as an advisor.
Yeah. The For you, if you are an individual advisor and you're doing it yourself, please pick out no load funds.
Yeah.
Uh, about half the mutual funds out there are no load, but most of them that are sold by a broker, of course, are load.
And again, homework assignment, everyone go look at their statement. Make sure you don't see an A, B, or C following the name of
Yeah.
the mutual
So,
fund.
so the two fund companies, or there's about maybe three or four very good no load mutual funds out there. Our Vanguard is one of the better ones. Dimensional funds are one of the better ones. T. Rowe Price is one of the better ones. Um, is there any others that you may recommend for the do-it-yourselfers that they should take a look at?
Those are the some of the best ones. You can stick with well, BlackRock has mutual funds that have loads, but the iShares, which they own, is ETFs that are again very low cost as well.
Yeah.
But like for example, I mean, in our portfolios, we use a lot of Vanguard and Dimensional products, ETFs, mutual funds, because again, they're low cost.
Low cost.
Um,
And that's the way you win long term in the investment world.
yeah.
Let's go to the next slide.
And so kind of going back, Pete, where I don't have that crystal ball. I wish I could tell you what markets are going to do. But markets are unpredictable. And that's where when markets are down, like we saw in the month of March and the volatility during the month of April, you see these advisors preying on people who can't stomach that risk and selling these products. But what we know from history is markets have gone up about 10% per year. And this is chart showing all the way back to 1926. And so if you ask me what a market's going to do this year, I'd probably say they're going to be positive about 75% of the time and negative about 25% of the time, because that's what's happened roughly over the last 100 years. Markets go up more than they go down, but we have to live through those periods of down years. The good thing is, kind of speaking mathematically, this isn't a normal probability curve. You see it's skewed to the right, a lot more positive years. Like look at those down 20 to 30 and down 30 to 40% years, 5 years. And those are mostly around the depression, the dot-com bust, the financial crisis. They're not fun to go through. It's a nightmare to go through, but typically we recover from those losses within typically a 2 year period. We typically recover, I think, around 60 to 70% of losses within 2 years. Um, and then, like even the financial crisis, it took about 4 years to recover if you stayed invested that entire time. And then market goes on to new highs. That's historically what's happened. Um, and
And
so,
your financial advisor should, when they understand your net worth, when they understand your goals and objectives, when they understand your cash flow needs, takes this particular scenario so that you don't have to sell equities during a down period. Uh, this is part of asset allocation, part of uh, part engineer, part art.
yeah,
Uh,
diversification, building the portfolio that's suited to
yeah,
your risk.
yeah.
We like in personally, I mean, when we build a financial plan, we also stress test it. What if your portfolio is down 20%?
You do what ifs.
We do what ifs all the time. We try to actually reverse engineer it and break your plan. What would make you fail? And what's the probability of that likelihood? And then we make sure, again, like you said, cash flow planning is really important. If we do get that downturn, do you have the cash reserves to not touch your portfolio for a certain period of time to let it recover? Or are you really drawing down and needing that money? Then we want to take less risk. So those are all really important things, understanding your risk tolerance, your time horizon, and then you can kind of back into how much risk you need to take and what the
Yeah.
returns would be generated.
And the thing of it is that it's also to prevent you from making the big mistake,
Yeah,
because
yeah,
it's if we were talking right in the beginning about psychology and the brain. Well, in these depressing times, it does get kind of scary. I mean, realistically, because you turn on the TV, you open up a newsletter, etc., everybody's giving you bad news.
Yeah.
And you go, oh my God, I'm not, I can't go back to work. I got to
And
do
that's what
something.
sells. That's what
Yeah.
sells is that. That's why if
Yeah.
you turn on the TV, it's bad news sells. And so
Yeah.
that's constantly what they're talking
Yeah.
about.
So you need somebody just to hold your hand to get you through sometimes these crisis periods.
Yeah,
And it's somebody
and
who's a little bit more objective.
yeah, and getting through these crisis periods, again, the best strategy is a buy and hold. I'll uh, uh, throw out Warren Buffett's one of the greatest investors who's stepped down from his role at their weekend meeting. Um, and he is a long-term investor. And the reason why is you can ride through these periods of volatility that, again, are typically very short-term in nature. And what this chart is showing you is if you're 100% stocks to 100% cash or treasury bills, or a more moderate 60% stock, 40% bond portfolio, this is showing you the chance of a negative return probability based on your holding period diminishes greatly. Even if you're 100% stocks, the chance of losing money over a 10-year period is about 4%. It's very hard. There's a chance. There's always a chance. But based on history, it's a very, very slim chance. And a 60-40 portfolio, most kind of advisors start there and scale up or down based on risk and time horizon. But again, you look out 5 years, even if we have a recession, a market correction, if you hold for 5 years, the chance of having negative returns is only about 5% over a 5-year period.
And at 10%, it's zero.
And no negative return, it's 0%.
You know?
And so, based on history, I can't tell you future is going to be the same, but
Yeah.
but advisors that sell products for commissions, these index annuities and other things, saying you have no downside, will cap your upside over, and you're stuck in this for 10 years. It's because they know these numbers. They are taking on the risk, but they know if I hold this for 10 years because I've locked this
They're-
client in
yeah.
for 10 years, this investor, I've only got a 4% chance where I'm going to lose money, and I'm likely going to make money and put that in my pocket and take it from
There,
the
another way of putting it is there is no secret sauce. They
no
are
secret
said
sauce.
insurance companies, Morgan Stanley, they're subject to the same whims of the marketplace that you and I are.
Yeah.
They don't have, unless they're insider trading, uh, they don't have any more info. They don't have any more predictability of what will happen in the future than you and I do. It is just too complex.
Yeah. There's so
It's
many
just,
different factors from inflation to interest rates to geopolitics to
yeah,
economic growth to guess where markets are going.
yeah.
I mean, we may have insights. We're not sticking our head in the sands and going, "Hey, we don't know anything." But trying to time and guess those things is next to impossible. And if you get it right, people get it right every once in a while. They're typically not right continuously every single time. And you see that with some of these people that called the financial crisis. They got that right, but then they were wrong for the next 15 years until
Yeah,
they're right again.
and that's not to say that you don't try to um, understand the market.
No,
In
yeah,
other words, if you, let's say, for example, that you believe that the equity market in certain sectors, I'm going to call it the S&P 500 price to earnings ratio is really low. You may put more monies into that sector by maybe 1 to 5%.
yeah, absolutely. If something valuations are the best guide over long-term returns. The cheaper something is, the better long-term returns are, historically speaking. Stocks tend to revert back to the mean, and so we tilt portfolios and allocate more dollars based on that and the outlook for certain asset classes, or we reduce money, or we stay at higher quality depending on the outlook. But getting in and out of the market and that whipsaw, that's not what we do at our firm. Timing, again, we think is very, very difficult.
Uh, because we're looking at the slide saying buy and hold, talk a little bit about what does harvesting your portfolio mean?
Yeah, so we recommend doing taxless harvesting in taxable accounts, where if you've got a loss in a position, and I'll give a classic example. Say I bought Pepsi, and Pepsi's down. I can sell that stock, reinvest those proceeds into something similar like Coca-Cola, have similar upside. I just was able to take that loss, offset any realized gains that I had in my portfolio, up to 3,000 of ordinary income, and still stay invested in the market in a similar type name. You can do that with exchange traded funds as well that track different indices. So there's ways to minimize the tax impact throughout the year. And then the other thing is you want to buy and hold typically for over a year for gains, because uh, if you hold it for a year plus a day, you pay what's called long-term capital gains if you sell after that date, which are taxed at preferential tax rates. Whereas if you sell before that 12 months, you're paying ordinary income tax rates.
Yeah. So let's go to the next slide. We've got approximately another 15 minutes.
Oh, good. I'm actually towards the end, so we finished
Super.
a
We got
good
some time
time.
for Q&A if there
Yeah.
are
So
any.
the
But
last
this is a
thing,
great, great slide. I love this.
yeah. So be aware of the latest fads. History has so many examples of these kind of hot tips or and latest fads, all going all the way back to the beginning of time. Go back to 1600s, the Dutch tulip mania. Tulips were the hot product, the first bubble in modern history that has been documented.
They were
Um,
selling for, I think, close to 150 or $250 per tulip bulb.
yeah, yeah. And the Dutch Trading Company was the biggest company at the time in the world. And
Yeah.
then you go through railroad mania, the Great Depression, the financial crisis driven by mortgages, where anyone and everyone could get a mortgage. Banks were lending, banks were doing, I mean,
Oh,
bad lending.
the dot
Investors
com
were,
area. I mean, for about 4 or 5 years, the S&P 500 was returning over 35% a year.
yeah, during the dot coms, and then it blew up and went nowhere for almost 10 years. Again, valuations got stretched and people were chasing these fads. The pet.com that went bankrupt. Even great companies today, Microsoft, Cisco and Intel still haven't recovered since that .com. Microsoft has, but it took almost a decade for Microsoft to recover and hit new highs after that.
What
Valuations matter. The new theme today is artificial intelligence. I truly believe artificial intelligence will make things more productive, and there will be great companies out there, but valuations are high, and great companies we may not know about yet. Think of going back to Amazon for the .com. Amazon back then was selling books. They were a online bookstore vendor. Now they have cloud services and a giant retail uh, organization that can deliver a box in 24 hours, if not the same day. It's amazing.
Yes.
Facebook wasn't around during the .com. That came out of the ashes of that.
What are your
Um,
thoughts on crypto and the the whole craze there?
yeah, I if you can't understand it, don't invest in it. Is my mantra. And I frankly I don't understand crypto. We've done a lot of homework around it, and maybe that will change over time. But I feel like it's kind of the Wild West. If it's kind of just made up money, the technology behind it, I understand could be useful. But if I just created something, and the argument of like there's limited supply of Bitcoin or other cryptocurrencies, but anyone can create a crypto. Trump created a crypto or a stable coin this year, and there's something like 20,000 different cryptocurrencies out there. So there's unlimited supply because anyone can create it, and there's no tangible income coming from it. Again, as a stock owner, I own a stock. I get dividends. I participate in the earnings as a shareholder of that company. A bond, I get income, something tangible in my pocket. Crypto is what is driven by demand and supply, and that demand can dry up. And again, supply I think is unlimited too. So we're not investing in cryptocurrencies for clients.
And
Um,
in the 1980s, I was working for a financial planning association, and one of the hot products at the time was limited partnerships in rabbits. And
rabbits.
the yeah, it was rabbit fur, and rabbits multiply rapidly, and therefore you could use the skin to make clothing and this and that and the other thing. You know, if somebody's selling you a limited partnership, should you take a serious look that's not on the exchange?
Yeah, really serious. Anything that's private, non-traded real estate investments, limited partnerships in real estate or other alternative investments.
Oil and
Again,
gas?
oil and gas royalties. These are very illiquid or very illiquid products. Typically, you can't get money out of them for a very long period of time. They typically have very high fees. So just make sure again, why are you buying something? Does it make sense for your goals and objectives and your risk tolerance?
Yeah. Limited partnerships, by the way, oil and gas are very difficult to do the tax calculations for. So, CPAs charge extra for on an annual basis to do those types of tax returns. State income taxes are on royalties and oil I've seen tax returns that are 70 to 80 pages just because of limited partnerships ownership.
Yeah, because you have to file in each state where you're getting royalty income from.
Yeah. And the other thing too is that they're illiquid.
Hmm.
So, the beauty of the exchanges are there are certain capital requirements. Is that correct?
Yeah, you have to. I mean, there's a level of higher transparency and liquidity that are required for funds that are registered. They
So
cannot be buying illiquid investments in a mutual fund or an ETF or only a very small percentage.
So you want to make
So
sure that the investment is on the New York Stock Exchange or on the NASDAQ, because what would you call them? Uh, uh, these platforms that make sure that the trades function efficiently.
exchanges, yeah.
Yeah, the exchanges, they do their due diligence to make sure that there's liquidity there.
Yeah, and they will kick companies off if there's not that liquidity.
And by the
Unfortunately,
way, they get fooled as well. So
there's been plenty that fooling, like from examples like Enron to mutual funds getting deregistered and so on. So yeah, just because it's registered doesn't mean it's safe and everything's clear to invest in it.
in the
But it does at least provide some comfort that there's a level of transparency and liquidity there.
yeah, in the investment world, because it's a sales world, there are scams galore out there, selling some sort of a secret sauce, promising you to make lots of money.
Yeah.
Additional resources.
Yeah, so we are huge believers in education and making sure that's why we participate in the series. Pete and the team are just doing a great job and the great lineup of speakers. And so not only on the It's Your Money and Estate website, great resources there. Would point you to our website as well for different blog posts, short videos. We host a summer and fall webinar series as well, all purely educational. There's also other resources directly on FINRA and the SEC about index annuities and variable annuities. So in the actual presentation that's on the It's Your Money website, these are live links that you can click through to. So I recommend just continue to arm yourself and educate yourself and ask questions. Make sure you know what you're getting into and why. And
Yeah,
if you can't figure it out, talk to an advisor.
yeah, spend the time up front. I don't manage my own personal money because I've got lots of better things to do, and we trust the feeling of advisors to do what's best for me. Uh, Please give Michael a call if you need something to review. Let's open it up, Fuad, to any questions that are out there. And you want to explain how an attendee can ask a question?
Yes. Well, for the people watching this video on our website, thank you for watching. Tune in for next video, which will be equity and fixed income investing with Mark Hebner. And thank you, Pete and Michael, for this great presentation. And we'll see you on the next video. Thank you.
Okay.